Hello everyone and welcome to This Week in the Markets. This week there were a number of economic reports in US with a mixture of both bullish and bearish signals. Despite that, the S&P 500 closed above the 1500 level for the first time since 2007. Globally, we are seeing bullish momentum in the manufacturing sector in both China and Europe. And in Japan, the government approved a draft budget for the coming fiscal year, amounting to over $1 trillion US. So we'll go quickly through the disclaimer and then we'll return to look at this news in more details. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So the new home sales data last week revoked our bullish hypothesis for the housing market in the US and confirms the weaknesses in December. New home sales fell 7.3% last month to 269 million, slowing down substantially from the 9.3% growth in the previous month. Analysts were expecting 2.1% increase, so this was quite a disappointing figure. On top of that, the pending home sales, which usually gets converted to existing home sales in 1 to 2 months' time, also came in a lot weaker than expected at negative 4.3%, compared to a 1.6% increase in November. Of course, this could be just a 1-month anomaly, but it does suggest that perhaps the market has gotten too optimistic that the Q3 program would create more sales, but instead it might have only just pulled some sales forward. Nonetheless, as we can see in the previous two charts, the trend in the housing market is still positive and is still showing improvement despite weaknesses in December. On the other hand, durable goods orders jumped 4.6% in December. This is its second largest increases in 2012. Durable goods are defined as items that are intended to last 3 or more years, and as such are generally very labor intensive. Therefore, a strong durable goods tends to be a good precursor to activities and hiring in the manufacturing sector. As a matter of fact, the ADP private employment report does suggest strong employment in January, as 192,000 jobs were added. This is 27,000 more than expected, and the December report, however, was revised downwards from 215,000 to 185,000, but overall we still see it as a reassurance that the economy is recovering and there is positive momentum in hiring. We have to look for confirmation in the Friday's non-farm payroll report, which will be released tomorrow. The initial estimate of the fourth quarter GDP found the national output shrinking by 0.1% during the last 3 months of 2012. Not only was this a sharp decline from the third quarter's 3.1% GDP growth, but it also came in as a big surprise to analysts who were expecting the GDP to increase 1.1% in the fourth quarter. However, there is a silver lining to this data. The decline could mainly be attributed to the large decline in the government spending, especially in defense, which shrunk by 22.2%, and this is the largest reduction in 4 decades, whereas the consumer spending was actually quite strong, spending at an annual rate of 2.2% compared to 1.6% in the previous quarter. And as equities in US continue to rally, investors seem to feel more confident about the market and are slowly returning to the investing world. Last week, the double AI measure of bullish sentiment jumped 8.4 points to 52.3%. This is 13.3% above the long-term average and is the most optimistic investors have been since 2011. And separately, the Thomson Reuters showed that the stock mutual funds in US attracted $3.66 billion last week, making a total of $6.8 billion being shifted into the US stock mutual funds in the first 3 weeks of this year. And this is the largest move since 2001. Both these data indicates a surge in optimism amongst investors in US. In China, the HSBC manufacturing PMI, or also popularly known as the flash PMI, rose to 51.9 in January. This is the highest level in 2 years. This is a positive indication that the Chinese economy has most likely avoided a hard landing and is slowly expanding again. This should also help to give industrial metals some tailwind, for example copper, which seems to be breaking out of a long-term consolidation pattern as we can see here. In Europe, the market composite PMI came in a fair bit better than expected at 48.2. The composite index is a combination of both the service and manufacturing industry. Analysts were expecting the pace of contraction to remain almost around the same as a month ago, but instead the improvement was better than expected, and there was actually a positive trend there. There were also news over the weekend that the US and the European Union are in final discussion on a free trade agreement, which is expected to boost Europe's economic output by about 65 billion euros, or equivalently to 0.52% rise in the national gross domestic product. The Euro Trade Commissioner is expected to wrap up the agreement when he travels to Washington on the 5th of February. That should help to boost the European economy and in turn improve confidence in the market. In Japan, government approved the first full-year draft budget compiled under the new Prime Minister Shinzo Abe, which consists of 92.6 trillion yen in spending. This is supposed to raise tax revenues above bond issuance for the first time in 4 years, but still it would push Japan's debt situation further into uncharted territory, and therefore increasing its risk of being attacked by bond vigilantes, like in the case of Europe during the debt crisis. This could potentially cause the Japanese government bonds to fall in value over the long run, which would in turn weaken its currency. And that's all for this week in the markets. Next week we'll get a look at the non-farm payroll report, which is a much watched indicator of employment situation in US, as well as an indication of how well the manufacturing and service sector are doing. So until next week, on behalf of the Trading Pursuits team, we wish you all profitable trading.